Let's get straight to the market reaction to the Fed. Major averages close sharply lower, yield spike, volatility index surges higher. Joining us, RBC Capital Markets head of equity strategy, Lori Calvasina, and Jefferies chief market strategist and CNBC contributor, David Zervos. Lori, it's a genuinely bad day. I mean, sometimes it's hard to keep perspective on what a bad day looks like. But, 1,000 points on the Dow isn't what it was 4 or 5 years, 10 years ago. But it's quite a bit. Is it warranted, given both where the market was and the hawkish part of this cut?
So, look, the thing that's interesting about this, right, is our rate strategist warned us that, people were feeling pretty hawkish coming into this. So I would say that the content of the statement, maybe the market reaction is a little bit surprising. That being said, if I think back over the last 2 weeks, and I've been running around the world talking to investors, and I keep hearing people telling me they're nervous about sentiment, they're nervous about valuation, they think a too rosy view of policy has been taken by markets next year, and everybody I talked to is looking for a pullback in January. So to see some of that risk come down and to kind of see some profit taking here on this, maybe it shouldn't be all that surprising, just given where we are.
Okay. Want to mention Micron is out. We are going through it. That stock is down sharply in immediate reaction. David, some of the names that had risen most this year sold off the most today. I mean, some of that, of course, is interest rate sensitivity, but not all of that. I mean, Bitcoin was down quite a bit from where it was, not necessarily interest rate sensitive. What to make of that, and perhaps a sentiment shift coming in the market?
I think there are just a lot of people thinking about the policies that are going to come into place. Chair Powell talking about tariffs. There was a big back and forth on that. Being a little cryptic on neutral and sort of not really giving us something to hang our hats on with neutral. I think it was nice to hear some of what he said, which is we're still quite a distance away from where they think neutral is, so policy is still meaningfully, use the word meaningfully restrictive. But, he's in no rush. The market likes it when the Fed has their back, and he basically said, I don't have your back as much as I had it for the last couple of quarters. And I think that's got people a little nervous. I'll tell you what, John, the one thing there's something that bugs me about all this. When we get these sell-offs and we get everybody lathered up about inflation and tariffs and deficits and interest on the debt and, oh, my God, it's all going on. The one word we didn't hear, deregulation. And I just want to throw it out there. I want to get it out to our viewers and say, that is great news. That is disinflationary and great for growth. And I just hope we hear more about the executive orders that are going to come through on January 20th that are all cutting the red tape associated with every sector and every business that's going to make the cost of doing that business lower, and we could transmit that into higher profits and lower prices. Nobody likes to talk about the rosy stuff. We got a lot of haters out there that like to focus on the negatives. I'm going to throw the good stuff out there. It's getting Christmassy, too. So
okay. And listen, it does seem, and this is from my own conversations and my own reporting on this, it does seem like you have an administration that is very seriously going to hit the ground running come January 20th, especially when it comes to executive orders and the possibility of deregulation. Looking at this market right now, Lori, we're down, finished the day down 1,100 points on the Dow, S&P down just about 3%, 5872 now. I know you got 6,600 on the S&P for next year. Is this a buying opportunity? And if so, where would you be buying?
So, look, I think at this point in time, right, we had speculated that any pullback would be of sort of 5 to 10%, right? Unless you sort of hit that 5% threshold on the S&P from the peak, you're not really, I think, getting enough froth out. And if we look at valuations for next year, if I sort of piece together some of the things we heard today, higher inflation forecast, dialing down some Fed cuts, those are things that compress PE multiples. So we're going to have to work, through some of that. And, I think just in terms of like what's baked into the market, or is nobody paying attention to all the good stuff like deregulation, I would beg to differ a little bit on that, because if you look at the CFTC data for U.S. equity futures positioning and S&P 500 specifically, what we are seeing is that, maybe about a month ago, we were hitting brand new all-time highs and we were breaking through the prior ceiling that tend to pin in the market. Guess when the last time was that we did that? January of 2018, late 2017, when we had baked in all the euphoria of tax reform from the first Trump administration. And, we had a little bit more to do. We passed the bill in December. We had a little bit more to do in January. But as I have talked to investors the last few weeks, what I am hearing is that there's a concern that we are only baking, kind of the market-friendly stuff into the market. And you can certainly see it in that positioning data. And that's got some folks nervous.